Welcome to Know Your Money, where we will explore our relationship with money and how the psychology of it impacts our financial decisions, as everyone thinks about money differently. In our podcast, we'll be presenting a variety of financial topics in an easy-to-understand way, which we hope will assist you with managing your money. Hello, everybody. Welcome to Know Your Money. Hello, Warren. Hello, Craig. How are you today?
Very well, thank you, Bronwyn. Craig, it is good to see you, though.
You too, Warren. Bronwyn, also good to see you. I see we have Candace back in the studio. Wonderful.
Absolutely. I think people found quite a lot of value in that episode that she did explaining those two differences. So we thought she could come back and explain a few more. And one that we found in the industry that a lot of people don't know and a lot of advisors don't even sometimes know, but with an endowment, which is a 5-year term investment, there's two options. You can have an endowment or a sinking fund. So we thought maybe Candace can just explain what an endowment is sort of on a basic level, and then what the difference between an endowment and a sinking fund is, and why would an individual choose those differences. Endowments can be used by companies and trusts, but we're not going to really get into that today. We'll just try to stick to the individual level. So hello, Candace. Welcome.
Hi, everyone. I'm very excited to be
Welcome
back.
back.
Right.
Yes.
Yeah, we're talking about a topic that is often very misunderstood in the industry. And I think it's probably one of the most beneficial products that we offer to the market. Today we're talking about endowments and sinking funds. An endowment, as Bronwyn mentioned, is an investment. But really, I think the important question to ask yourself is, why would I even put money in a sinking fund or even an endowment? And really, it's for clients that are in a tax bracket, anything from 30% and higher. And
So one question on that. If you are under 30%, should you ever use an endowment?
Personally, I don't think so, because you would then be paying more tax.
Sorry, guys. Endowment. Brief description for the idiot here. What is it? Because
Okay.
you said something about 5 years.
Okay.
So an endowment is basically a product, and it's a structure that you can place money into. Once you put money into this endowment or a sinking fund, it has a 5-year restriction period. What that means is you basically restrict it within the 5 years of how many times you can withdraw money, essentially. So theoretically, you're entitled to one withdrawal within the 5-year term, which is what we call the restriction period. Once this 5-year term has passed, then it is open and you can take money at any given point.
Okay, thank you.
Makes sense.
So the endowment, Warren, as well, you have a forced saving. For example, you're saving for an emergency, or you're saving for funds, education, and you purchase an endowment, save money every month in the endowment, and you'll have a nominated beneficiary. So it can be a forced saving every month, and you can also put a lump sum in as well. If you want to have a lump sum endowment, you can do that. And then you have a beneficiary. You nominate Kirsten, for example, as your beneficiary. So that's a way of making sure the money goes to the right person. Doesn't
Right.
form part of your will.
And so the 5-year restriction
Yes.
on the one withdrawal.
Yes.
After that, does the endowment continue to operate?
You can.
I don't know how to say that, but yeah.
Correct. So it can continue. And so you don't have that restriction with the withdrawal, and you can withdraw at any given point.
So it's open-ended.
So for example, you put in 100,000 Rand and some emergency comes up and you need to withdraw. So you choose to withdraw 50,000 Rand. That remaining 50,000 Rand you can't have access to until the end of the 5-year period. Am I right in saying if you do have access to it before then, that there's penalties, or how would it work, or you just that money's locked in?
Not with Allen Gray, so there won't be any penalties, but you won't have, once you make use of that once-off withdrawal, you don't have access until that 5-year term is over. Then it's open-ended.
And where is that money put with Allen and Gray? Is it like we spoke about in the previous episode, where you know certain funds, or
Correct.
Okay.
Correct. So your financial advisor would decide, based on your risk profile, what funds are suitable for you.
Right.
And that would determine the growth of how your money performs within the product.
Right. Okay. So the endowment is almost like the rules, if that makes
Yeah.
sense.
Correct.
Okay.
It's
Yeah.
the vehicle that you place the
vehicle.
money in.
Yeah. And then,
Correct. And then there's a number of rules here. So, I mean, the primary thing is it's suitable for a client that's in a tax bracket higher than 30%. So as Bronwyn mentioned, I wouldn't even consider the product if you're not in that tax bracket. But one of the main benefits of the product is you obviously are paying less tax if you're in a 45% tax bracket, but also the estate planning benefit. So if anything happens to you, you nominate beneficiaries and the product can...
Right, that makes sense. Yeah.
Correct.
Yeah, I
So in
get
a
that.
unit trust, you can't nominate beneficiaries. In an endowment, you can. And then back on that tax bracket, an endowment, you want to explain how it's taxed and why it would be beneficial.
Great question. So with a unit trust, as an example, you would get tax certificates. And then you as the investor would then have to submit your tax return. In an endowment, it is a very convenient product because SARS actually doesn't know who the underlying taxpayer is, because in my scenario, Allen Gray Life or the life company is the taxpayer. So when you in an endowment and you decide to do a switch and you switch from one fund to another, or you make a withdrawal, capital gains tax will trigger. And Allen Gray or the life company will pay the tax to SARS on your behalf. So you would never, ever get a tax certificate for an endowment because the life company actually pays the tax on your behalf.
So the money you get out, you don't necessarily declare or do anything with that. That is your money because all the taxes have been paid.
100%. So if you do a withdrawal, this
Lauren
is
seems
paid.
intrigued.
So why isn't that the only thing that people choose then, if you don't have to pay the tax if it's paid on your
Because
behalf?
it's restricted to the 5-year term.
But still.
And it's only for people for over
The
the
30%.
30% that it would necessarily be beneficial for.
Okay.
Well, I hear that. I understand that the higher the tax rate, the more beneficial the endowment is. But one of the big features is the nomination of beneficiary.
Correct.
So
Versus-
that would be a reason why I'd purchase an
So
endowment.
wait,
even
so-
if I
So
was
you'd
on
put someone that had a lower tax bracket in there because you can nominate a beneficiary
Yeah.
and it can come out of that
So
person's
wait,
estate.
is it a requirement that I be in the 30% tax bracket for me to have an endowment?
No.
Absolutely not. No.
Right.
No.
It's just what Candace is saying is if you're below the 30% tax rate and you're in there, you're paying higher tax on that money than you would have if it was in a unit trust.
Correct.
Okay?
Right.
Because you're
okay.
going to pay 30% tax on that instead of
Irrespective.
18% tax on that because 18% is your tax bracket.
Understood. Okay.
And what Craig's saying is it still might be beneficial for some people to rather pay 30% than 18% because you can nominate a beneficiary on there. So if you have an estate and it's worth a whole bunch of money, you can nominate a beneficiary and that person can get the money directly and straight away. The estate takes time to wind up and then any of your unit trusts are tied up in with that, whereas an endowment pays out to the beneficiary.
So when you say, sorry, just to understand that whatever the fund you're in, and when you say the insurance one, for example, will pay the tax on your behalf, is that out of the capital gains in your fund, in your account?
Correct.
Yes. Okay.
So if you've made a gain on the funds that your financial advisor put you in, so as an example, you put in 100 Rand and it's grown to 200 Rand, that is 100 Rand gain.
Yes.
That tax only triggers once you've sold out. So in other words, you've withdrawn or you've switched out of that fund into another. So that's seen as it triggers capital gains tax because you're selling out of the fund.
Okay, but it's paid on your behalf by Allen and Gray, so you
Correct.
don't have to get involved with SARS.
Correct.
100%.
So it's just easier for a start. So if weird example, let's say I've started one for my son for when he turns 18. He's a little baby now. When he gets to 18 and he withdraws the money, does he have to declare it to SARS, or has it already been
No, it's
sorted?
Already been done. There's no tax certificate. So if your son at the age of 18 does a withdrawal, we would pay him net of tax. So
Right.
So he would get the net amount. And this is one concept that is often misconstrued in the industry because some people would say, oh, we have this product and it is tax-free. It is not tax-free.
Yeah, correct.
That's where I was going with this because it sounded too good to be true.
You absolutely
you
pay tax.
but
the
you
product.
don't physically pay it. The company pays it on your behalf.
Yes, yeah. So it's
And it's
not
quite-
something you have to be aware of. Effectively, you're told this is your net of tax.
Yes.
effectively, at
And
the
it's
end.
quite legal. It's not illegal at all. So when that endowment matures, the money gets put in your bank account, and you don't have to declare it to SARS because Alan Gray is doing that all the time on the back end.
Right.
Whereas the unit trust, which we discussed in another episode, with that, whatever that capital gains tax is, goes on to your tax returns for that.
Right.
There's certificates issued for those directly, which you have to submit to SARS.
So
Yeah,
is
and
it
Alan Gray would issue those certificates
is
for
an
you.
endowment
but-
a flat 30% tax then?
So I'm glad you're asking that question. So we said that it is beneficial for any client that is in a 30% tax bracket and higher. And here we're obviously talking about your marginal tax rate. But how much tax do you effectively pay in this product, right? So there's this concept called your capital inclusion, your capital gain inclusion. So that's 40% essentially. So you only pay 40% of the gain that's incurred in the product. So essentially, effectively, how much tax you pay in an endowment as an individual is basically the 40% times your 30%, which effectively is 12%. So you're only paying 12% within an endowment. Now, if I compare that...
Okay, wait, let me just explain.
You just blew my brain.
Okay.
Yeah, let's go again.
So your capital gain is 100 Rand.
Yes, correct.
Okay. Your inclusion amount is only 400 Rand, 40%. That would go towards the tax amount. Does that make sense to you?
No, go again.
Okay.
Sorry.
So the 100 Rand example, so we said we've placed 100 Rand into the product.
It's grown by another 100, yeah.
It's grown by another 100. So your gain is 100.
Correct.
So your inclusion, how much is actually SARS includes in their calculation, is 40% of your gain, which in this
How much
example...
can they charge tax
That's
on?
a rule.
which is
40%.
the 40 Rand, which is 40 Rand of the 100. So your
400
gain...
Rand.
Yeah.
So your gain has only been 100 Rand, but it's 40% of the 100, which is 40 Rand.
Understood, yeah.
Okay, so they can only charge you tax on 40 Rand.
So I get you. Okay, so they're charging the tax on 40 Rand.
Yes.
So the 30% tax
Of
on the
40
40%,
Rand.
which is the 40 Rand.
Which is the
Correct.
12 Rand or whatever it ends up being.
Correct. So
12%.
it's 12. So effectively, you pay 12% tax.
That's great.
That's great.
Yeah.
If you were in a unit trust, and let's assume you earn a lot of money and you're in the highest tax bracket, which is 45%.
And you've used your exemption, your interest exemption.
Correct. Then you would essentially pay 18% of tax.
Because, so it does take into account
Your
the bracket
marginal
you're in.
tax
So
rate.
you're on the 45%.
So then it would be
So it's the 45 of 40. I
Correct.
guess.
So
Yes.
this is
Takes
the
you to the
capital gain
18.
you're talking about.
Absolutely.
So that's why it
capital
doesn't make sense to do it unless you're above 30%.
correct.
Or 30 or above. No, that makes
Correct.
sense now. Okay, yeah. Okay,
Correct.
thank you.
But what is a sinking fund?
So there are two types of structures. So there's the endowment and then there's the sinking fund. So maybe I'll start off with the easy one, which is the endowment. So in an endowment, we call it an endowment when you have this concept called a life assured. So essentially, the endowment is based on a person, which is your life assured. So I'm going to bring that home and I'm going to make it real. So I have a son and a husband, and we open an endowment. I am the plan holder, essentially. So I'm responsible and I own the product, but I want it to be based on my husband and I's lives. Okay? What that essentially means is we are the lives assured. So in the event of our death and something tragic happens, it must pay out to our son, which is the beneficiary. So the endowment structure is, it is based on someone's life, and when the last live assured dies, it pays out to your beneficiary. That is in an endowment structure. If you open a sinking fund, it is the same rules as an endowment, but there's no life assured. So it's not dependent on anyone's life, and it can continue.
Right. So
How's it issued though?
Yeah, so do it carry on in your example of your...
For your son and your husband, how does that work?
So in a sinking fund example, there are no lives assured. I am the plan holder. My husband is what we call the beneficiary for ownership. So if anything happens to me, then he takes over the policy. So he becomes the plan holder.
And if anything happens to him?
If anything happened to me, he can nominate another beneficiary
So like your
for
son.
ownership.
Right.
Not the son.
He can nominate the grandparents.
Right.
So if we both die, somebody else, you can keep adding a beneficiary for ownership to take over the plan if anything happens to
So
us.
could you nominate it to the estate? So as in, because obviously if you say both died and you hadn't nominated anybody else, how would that work?
So it has to be somebody that would be responsible. So it can't be the estate. It has to be someone responsible to take over the plan.
Right, okay.
So a sinking fund may not be the best option for, in your case, about your husband and your son.
It depends on the intent of the family. If my husband and I wanted to pay out immediately to our son in the event of our death, then we would definitely want an endowment structure, because with an endowment, it ends when the last life assured dies. The plan no longer exists and it has to pay out when the last life assured. Where people want continuity and they don't want the policy to end, they typically go for a sinking fund because it isn't based on someone's life.
So if
Could
we're
you give
talking
an
like,
example?
I was going to say like generational wealth. Would that be more of a sinking fund then?
So sinking funds actually typically are more like popular in the market because it's quite a bit of admin. You can add in an endowment structure, you can add people through the life of so we can continue to add his parents or my parents. So you can actually build continuity in an endowment, but that's administrative, right? Because then we have to keep adding someone, a new life assured through the life of the policy. A sinking fund, you don't have the admin piece of adding people. So if I have to bring it back to a sinking fund, we could have me as the plan holder. We have no lives assured because obviously it's a sinking fund. We want it to continue even if both of us pass away. He can be the beneficiary for ownership, and I can then add other people, a secondary owner to take over in the event that both me and my husband die, that somebody else takes over the ownership, like my parents, if we both die, but it isn't based on someone's life. So you build so someone keeps taking over as plan holder.
So does the plan holder have to be over 18?
No.
And what about the 5-year period? Does that apply?
So the 5-year restriction period still applies both for an endowment and the sinking fund.
On death as well?
So what happens to the restriction period when it passes on to a new plan holder? It falls away. So as an example, if it's an endowment structure and my husband is the life assured and I am also a life assured, what I pass away, it passes over to my husband. Let's just say I had 3 years left of my restriction period. It then passes, the restriction period falls away completely. So he becomes the new plan holder and there is no restriction period.
Oh, okay.
But that's on the sinking fund.
On both, the
Both of
restriction
them,
period falls.
Okay.
So when the plan holder passes away, the restriction period changes. So
You
I just
don't
want
have to wait the 5 years. That's what
go
you're
back
saying.
to the
Okay.
sinking fund. So like, say for example, I want to take out an investment. I've got 100,000 Rand now, and I want my son to have access to that at 18. And I choose the sinking fund option. Is the plan holder restricted to keep that policy till my son is 18? Or if it passed the 5 years, could that plan holder say, okay, no, well, I want to take the funds out anyway?
So you be entitled to that one withdrawal within the 5-year time frame. If you make use of that withdrawal and you do a part withdrawal, you won't have, you can't do another withdrawal until the 5 years has passed. Once the 5 years have passed, you can take out money at any given point.
As parents, sometimes a sinking fund is a better option because you can put that money in there, and if you pass away, that full amount of money doesn't become
Because
estate
it's not
dutable.
part of the estate.
Does that make sense?
Yes, 100%. Yeah. But it's still subject to capital gains, just like a
Yes.
endowment.
So it will be estate dutable for the policy holder. So it will be included as an asset, which means it's subject to estate duty, but there won't be executor fees. There are certain exemptions where it will be excluded. So as an example, if the spouse is a beneficiary, then it won't be estate dutable. So that's one of the exemptions as an example. So the capital gains tax, if in my example, if it goes to from one individual to another, So at death, the plan holder, or the beneficiary of ownership that takes over the policy, has a choice. Do they want to withdraw the money, or do they want the plan to continue?
Yes.
In the case that they want the plan to continue, it's going from one individual to another, so within the endowment policy. So it goes from me to my husband, but he's now the plan holder. So there won't be capital gains tax at that point. He absorbs what we call what I bought into the fund for. So he basically becomes the new plan holder. There's no capital gains tax because we're both individuals.
And nothing, you didn't withdraw any funds or anything like that?
Okay, and let's say your husband is in the same tax bracket as you, for example, and eventually after 15 years he decides to cash out. Is you passed away 5 years later, he became the holder, 15 years later he wants to cash out. Is he looking at capital gains for only those 15 years and not the 20?
So the capital gains for him, so remember, the one important thing to remember here is his marginal tax rate is irrelevant because Allen Gray Life, or your life company, is the tax payer. So it's still the 30% within the endowment and the sinking fund.
Yeah.
And then with respect to, he absorbs whatever I bought into the fund for. So if I bought into the fund for, let's just say 10 Rand, and it's now, I passed away, he absorbs the cost. So it goes to him at 10 Rand. So if it's grown to 20 Rand, he pays the 10 Rand gain.
Right, okay, understood, yeah.
So basically the cost just passes on from me to him.
No, that makes sense.
From him to his mom.
Yeah.
The costs continue, but someone eventually is going to have to pay the gain.
Yes.
So the sinking fund would be a better use of it is in a company scenario.
Typically, we find more
Company
legal
owns.
entities
Okay.
open a sinking fund because you can't. They want it to continue, and in a legal entity example, they would be the plan holder, and we would automatically make them the beneficiary.
Is a trust a legal entity?
Correct.
So would a trust be more likely to use a sinking fund? Right.
In an individual case, when would one use that?
In a sinking fund, if they don't want it to be based on anyone's life, and they just want it. So in my example, we can still, my husband and I can be the plan holder, he can be beneficiary of ownership, and my son can be the beneficiary for proceeds. Even in the event of our deaths, nothing happens. Because remember, things shift when you're in an endowment. If I pass away, then my husband becomes now the new plan holder. But in the event of both of our, if we both pass away, it's forced to pay out to our son.
I think this highlights the fact that you need to consult with a financial planner and see which product would suit you as an individual. It seems like the sinking funds are suited for legal entities like companies and trusts.
Correct. And another consideration would be creditor protection, because sinking funds don't offer creditor protection where endowments do.
If I could put it in simple terms for everyone, just tell me if I'm wrong here. But a sinking fund is almost like if you are you have a bet on something and you want to just keep letting it ride. So you don't, once the action or someone dies, once that is over, it pays out, is an endowment. It's done.
Correct.
But a sinking fund is, let's just keep it going.
It keeps going. It's not dependent on anyone's life. I think the important questions to ask is, if you want it to be based on someone's life and you want it to pay out in the event of their death, then you go the endowment structure.
Right, yeah.
And if creditor protection is important to you, then I would consider an endowment. There is no creditor protection on a sinking fund.
And what is creditor protection, just for me?
So if you get into some financial difficulty and you owe people money, they actually can't claim it from your endowment.
But they can from a sinking fund.
Correct.
Okay.
So if that's important to you, you would go the endowment structure. If that is not important, then the sinking fund can be
so
an
there are
option.
subtle differences that make a big difference, really.
Correct.
Yeah.
So it is a complex product, but there are lots of nuances, and this is why you need an independent financial advisor to help you decide which product is suitable.
Awesome stuff. Thanks, Cans. I think that was
Yeah,
insightful.
Candace, thank you.
Thank you. I understood it.
Awesome.
Well, hey.
Thanks, guys. Have a
great
good one.
week.
Thank
All
you,
the
Candace.
best.
Bye, everyone.
Cheers.
Thank you for listening. If you have enjoyed this podcast, would like to subscribe, please visit our website, www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.